I personally think there's a little bit more downside to gold. This is the 1979 versus 2025 chart, and it's almost identical. If we look at that right here, it's right in here in 1979. We pulled back there, and then we started to move up. Here we have it right in here, and that tells me that we could come back as low as 36 to 3,500 before the next bull move. Now, important here, I think by next year, we're back at all-time highs. And so it is different. It's just the initial emotional reaction will be the same, but then gold should head back to new all-time highs. 5K next year to me is a no-brainer.
Gold will not go straight up. It will correct. And that's to be expected. You're not going to get a scenario in which gold goes in one direction. Really decent probability that the bull market is still in play. A move below 3,900 and continued downside would put less evidence to that fact, and obviously a break below, call it 37, 3680, would tell us we probably witnessed the best that we're going to see for a while. Doesn't mean it won't go back there in 6 months, but we probably won't see it through the end of the year or Q1. I am searching Q1 for 4,500.
Gold is entering a decisive phase in its long-term bull market as price behavior tracks almost perfectly with the historic 1979 pattern. After 9 straight weeks of gains and a firm correction, the metal is now retracing toward the key $3,600 to $3,500 zone, the same structural pivot seen before previous major breakouts. This pullback reflects not weakness, but the market flushing out weak hands before building the base for the next advance. With rising U.S. debt, political dysfunction, and a weakening dollar increasingly shaping investor sentiment, gold is solidifying itself as the safest asset heading into 2025. Gareth Soloway, a veteran technical strategist, and Gary Wagner, a longtime precious metals analyst, explain that this decline is a natural reset within a much larger bullish cycle, while the macro backdrop continues to push gold toward new all-time highs. Their combined view indicates a high probability of gold regaining strength, with targets of $4,500 in early 2025 and $5,000 within the broader cycle. Meanwhile, Bitcoin and equities carry far greater downside risk due to leverage, concentration, and weakening consumer conditions. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I personally think there's a little bit more downside to gold. I'm still, listen, I have a huge amount of gold that I bought for a long-term portfolio that I'm going to hold, and I'm going to keep holding that regardless. But I'm also a swing trader, right? So I'm looking to see, okay, where could it pull back to? And one of the things we saw is we saw this top back in October, this first retrace, a big bounce, and it stalled out right in here, and now it's starting to come in. And I'm going to show you something here. This is a really, really cool chart on gold. This is the 1979 versus 2025 chart, and it's almost identical. So in 1979, we had this first bull move, and then we had this sideways consolidation. In 2025, we had this first bull move and sideways consolidation. We then in 1979, starting right here, 9 straight up candles in a row on the weekly, so 9 weeks up in a row before the big correction began. And we had this time in 2025, 9 straight up weeks as well, starting right here before we started this correction. Now, the reason why I think we still have to go a little bit lower on gold is that, number one, there's too many weak hands in the trade still. That not enough people have been flushed out. The markets just generally want to flush out the weak hands before it bottoms out for its next bull run. The other thing to go over is look at what happened in 79. Where did we pull back to before we started to get a big bounce? The former pivot of the consolidation. If we look at that right here, it's right in here in 1979. We pulled back there, and then we started to move up. Here we have it right in here. And that tells me that we could come back as low as 36 to 3,500 before the next bull move. Now, important here, and this is big because I'm sure you're going to get a lot of comments of people saying, oh, it's different than 1979. You're 100% right. It is different. The difference is in 79 and the 80s, Volcker was raising interest rates. Right now, Powell's cutting rates, right? In 1979, debt to GDP, 32%, 130% now. Now we have a government that just keeps spending money recklessly. Back then, they actually had, bipartisan agreements to make fiscally responsible things. And so the difference here is that in 79, we didn't see those all-time highs again for basically 20 to 30 years, right? In this period now, I think by next year, we're back at all-time highs. And so it is different. It's just the initial emotional reaction will be the same, but then gold should head back to new all-time highs. 5K next year to me is a no-brainer. I think probably Bitcoin percentage-wise has more downside risk here just because it's more volatile. So if we look at that, for instance, so here we have the gold chart, but let's quickly flip over to Bitcoin. Let's bring that up and just take a look. So if Bitcoin goes down to my 75,000 target or 73,000 target, that would be a decline from current levels of about 23%. If gold breaks down to my 3,600 level or so, that's about a 12.5% drop. And then on the stock market, we've talked about that 10 to 15% drawdown. And again, that would bring us back. By the way, where am I getting 10 to 15%? It's our former pivot high right here. All right, so right around 6,100. This former high, as we broke down, once we break out, that becomes technical support. So Bitcoin has the most risk. The stock market to me is the most uncertain, where it could turn out that we're at a cycle high and we could see as much as 30-40% downside over the next few years, even though I do think that 10 to 15% gives us a bounce. Gold to me is the place where if I have to allocate money at any of these targets that we've talked about, I would probably do the most on gold because it's the least risky. And then probably secondarily Bitcoin at this point. Bitcoin is that, you have a lot of leverage built into the system. People can invest with large amounts of capital. And it also concerns me when you have entities like MicroStrategy, formerly known as, where they have so much and they've leveraged themselves. And I just, as someone who analyzes risk for a living on trades, it does make me a little nervous that certain holders hold so much Bitcoin, and if they get into trouble and have to liquidate, they could literally cause Bitcoin to crash more than what the crashes we've seen have been. Gold is much more diversified. Central banks are owning it. They're not going to panic, right? So central bank is not going to get wiped out. They can just print their own money anyways, so that ultimately there's more security, at least to me, in gold's price. To me, at least, that's how I view it. The biggest concerns to me is that historically, when you have expansions in the U.S. debt, during expansionary periods, when the government brings in more revenue, we pay down that debt, right? And then when we go into recession, they spend more, right? And because they have to stimulate, and then we run up our debt, then we pay it down. That hasn't happened in this latest cycle. We've just been adding debt, which ultimately creates a bigger bubble. And what we know is the bigger the bubble, the bigger the collapse, right? I mean, you look back at the financial crisis and what happened in real estate and the collapse there.
Gold's recent pullback is developing into a classic consolidation phase within a much larger structural uptrend. After an extended surge toward record highs, the metal has begun to soften, forming a series of consecutive red candles that signal temporary exhaustion rather than a breakdown in trend key support levels between $3,960 and $3,930 continue to hold the broader structure intact, and deeper support at $3,680 remains the line that separates a normal correction from an actual bearish pivot. The current price action reflects a market digesting an extraordinary run, forming a base, and preparing for its next directional move. Seasonal factors, thinner volume, and holiday trading conditions are amplifying minor fluctuations, but the broader chart still shows a healthy pattern of higher lows and measured retracements. As long as gold maintains its structural floor, the long-term bullish landscape remains firmly intact. Let's get back to the interview.
Gold will not go straight up. It will correct. And that's to be expected. You're not going to get a scenario in which gold goes in one direction forever. I think Ben Bernanke, former Fed chairman, put it best. He was talking about interest rates, but it pertains to gold. Trees don't grow to the sky. They never have. They never will. You've gotten three red candles right here. That's actually a candlestick pattern called three crows. It can represent a bearish continuation, but here it did not. It then found support at this level, a logical level, right around the 61.8. It came up and now it's moving back down. We don't really want to see gold make a lower low than, say, for 39.40. That's these lows that came in through October. That would bring into question whether or not we've gone into either a bear market or more likely a range bound market.
Right.
Because when you see gold move as much as it's moved, as fast as it's moved, you're going to get corrections, A, and B, you're going to get points in which it consolidates. It forms a base. And so after it comes up, it comes down. And this area here from, call it the end of October through the first week of November, even though it's not a straight linear line, you do have a range in there. That's a range. That's a consolidating market. But it did find support here. It popped here. As I said, the only thing I bring into question is you would like to see gold come and challenge the all-time record highs and to make a higher high. The fact that it's come down for 3 days doesn't tell us yet that the bull market is over, but it tells us that it didn't have the ability to make a higher high, and that brings into question whether or not this bull market will continue. I am more likely to believe we'll see range-bound activity, especially through the holidays, unless there's strong fundamental news to push the market up or down in either direction. It's as likely that the volume, and you can see it's decreased just a little bit. See how strong the volume was during this uptrend. You can see the volumes come down, and we are going into a holiday season. Traders tend to, rightfully so, want to spend time with their families and not stare at charts and take a break from the activity. So we can get moves that are exaggerated because volume goes down. Whenever you get thin volume, it takes less to move a market in either direction. Right now, all I'm seeing is a market consolidating with the possibility of lower prices. And I only say that because we've had 3 consecutive down days. If you look at this entire area of the chart, even here, you had a huge down day, another down day, and I'm just referring to it as a red candle. Here, you did not get a lower low. Here, you did not get a lower low. And then here, you had 1, 2, 3, 4 down days. And then it bottomed. It found support here. And here, the majority of candles have been green. So it moved back up, but it did make a lower low. Because we, excuse me, are in record territory, I can compress this chart till the beginning of the chart. It's not going to show us another time at 4,200. So as a technician, I don't have the tools to say, last time it was at 4,200, it did this, because the only other time it was there was right here. And that was on the way up, and then it came down. So we don't have a lot of historical data, which is a great thing because it tells us we're in record territory, and that's exciting. The key is this. I would like to see gold hold 4,000. I believe the new floor on gold is probably going to be 3,900 as long as we are neutral or bullish. A break below 3,900 is something that we want to guard for, and obviously a break below 37 or 36 tells us that we'll probably have seen the pivot from bull to bear. Doesn't mean the bull won't come back, but we are in a bear market and have to acknowledge that. Right now, we are not at the lowest low it's been since it hit this all-time record high. But my God, when we look at the basic move we've seen in gold, it's huge. The only thing that's really different when we think about the gold chart that we looked at and compare that to what we're seeing in silver is this is clear as day, a double top. And so a double top signifies a pretty strong indication, because for a market to come out up to a certain point, that's a new all-time record high, and come down, find support, and then move up, isn't telling us that much. But when it comes up to that same point and once again begins to fall, and now it's the third day, so it's more than a single day, Doesn't mean it won't find support at 49. Does not mean it will not find support at 47. But it brings into question whether or not we're looking at an absolute top. It is a all-time record high. Gold's all-time record high has not been challenged twice. It made it, and it's been below it ever since. Silver finally did something unique in its own price structure. It broke well above 50, which was the former level that we all looked at. It went higher than 53. We are looking at futures, so that's a little bit above spot. But the bottom line is there is a double top. We've seen 3 down days, but now we're at critical areas that are important to watch. 49.20 and 47. Those are price points that if it holds, we can easily make the observation that silver is still in a bullish demeanor. If it breaks below the 50-day, we can no longer say that with confidence because the chart, the numbers don't agree with that statement. That's all it is. I am searching Q1 for 4,500 if in fact we are witnessing a true and simple correction and not a pivot from bullish to bearish. I can't make either statement with confidence because there's just not enough data. I can say with confidence that after hitting 4,400, an all-time record high, it made a very acceptable correction just below the 61.8. In other words, went to 39, excuse me, and then popped back up. The fact that it made a lower high is challenging to make the assumption we are still in a fully bear market. What would make it a bear market? You've got an all-time record high. You come down, you form a base at 39, you make a lower high. If we make a lower low, that puts a lot of ammunition into those that say, well, we've pivoted from bull to bear. Until that happens, we can't make either of those statements, I'm sorry to say. And I'm basing this simply on the chart. Of course, it's going to depend on the fundamentals at play. And that I wouldn't even venture to guess what that could be. We don't have crystal balls, and when we do, they usually are just real cloudy. What we can say is that gold needs to hold above 39.40 to 50 on a technical basis. If it does, we're still fully bearish. I would, in a best case scenario, look for gold if it continues to go lower to find support at around 3,900. And then I would look to see if it can make a higher high than this high here at 4,200. If it can make a higher high than that, even if it's only to 43, it doesn't have to beat the all-time record high. That means that there's a really decent probability that the bull market is still in play. A move below 3,900 and continued downside would put less evidence to that fact. And obviously a break below, call it 37, 36.80 would tell us we probably witnessed the best that we're going to see for a while. Doesn't mean it won't go back there in 6 months, but we probably won't see it through the end of the year or Q1.
Gold's market structure is entering a decisive moment as momentum fades from the recent rally and transitions into a measured consolidation phase. The series of lower highs appearing after the move toward $4,200 reflects a natural cooling period following months of aggressive upside. Even with multiple red candles developing in succession, the broader structure remains intact as long as price continues to respect the major floors established throughout the $3,960 to $3,900 range. These levels have repeatedly acted as the stabilizing base of the current cycle. As volume thins into the holiday season and volatility becomes more sensitive to small order flows, price behavior may appear exaggerated. Still, the underlying trend continues to mirror the broader 2025 breakout pattern. Silver's structure, meanwhile, has entered a critical zone after printing a clear double top, bringing focus to the $49 and $47 levels as key markers of strength. Both metals are now navigating the delicate stage where consolidation, holiday liquidity, and macro shifts intersect. While short-term softness remains a possibility, the long-term setup still leans toward higher structural targets once the market recovers. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.